Venture capitalists will be half lying if they considered value over valuation. That's the word coming in from Kartik Reddy, the CEO of Blume Ventures. Speaking to my colleague Rachna Dhanrajani at the IVCA Conclave 2024, he said that venture capital firms should have the right size of fund in their strategy. He also added that India should bet big on the fintech space to achieve the $10 trillion economy mark. Here's a slice of that conversation.
I'd like to start by asking, you're one of the few people who's seen the startup ecosystem start, evolve and sort of witness it where it has reached now from the inside and pretty much shaped it. How has your experience been like, and how have you seen these trends evolve?
So yeah, 13 years when we started, there was, it was a very thin venture ecosystem. Private equity is more stable, so it doesn't grow as rapidly. Large amounts of capital. Tends to be typically global players and some Indian players, but basically evolves gradually. And you can see there's a concentration of some phenomenal players that have emerged there. Venture is constantly evolving. One, because early stage is generally small funds. We start very small. We started at 20 million, now we're 290 million in Fund 4. So that's like 11, 12x expansion. Actually, in rupee terms, it's a 20x expansion in fund size. To be able to see that kind of track record, establish it, see success stories, takes a decade. And then it just requires a lot of stamina, much like a founder journey. So the equivalent of getting to Fund 4 or 5 in our business is like taking a company public, right? And then the journey doesn't stop. It keeps going on. So for most of your viewers or my peers who are trying to set up funds or mimic what we did in Blume in 2011, the biggest warning is right size a fund for your strategy. Too much money and you'll have terrible returns, right? And I think that was our secret sauce in some sense.
We recently saw, we've been through a funding winter. 2024 is the year of comeback, where we're seeing founders being hopeful, VCs being hopeful, private equity being hopeful. What is your take on it in terms of monetary value of this year?
I think any venture person will be half lying if we say we looked only at value over valuation. I think that's more a recent trend. All of us were greedy for valuation, but you know that it has a limited timestamp on it, because eventually you have to make money for your investors, for which you have to be able to sell at that valuation. So the selling price is the valuation. So unbeknownst to most of you, a lot of our industry's portfolio, the stars in the portfolio, are significantly marked down to conservative values today, which is reflective of if they went public tomorrow, or if they raise money, or if they had to get it through an M&A, what would the price tag on these assets be? Right? So maybe half of them are holding up the valuation, the other half are marked down, right? So one is, I think we've all adjusted to how to value companies better at this juncture. So going forward, once that correction happens, it's not happened fully, that's what I was trying to tell you. So once that correction happens, then everybody recalibrates to saying, oh, now we've found value to be at par, adjusted for risk. My belief, and has been for 5 years, but finally loving the fact that it's happening in real time, is more companies going to the public markets and seeing how they discover their real price. And when that happens, a lot more money gushes in, is my take.
You recently had your 4th fund. What has been the allocation for that fund? Where is that money flowing in? And what are the sectors that you're betting on now? Yeah.
So I think Blume's, again, good or bad, it's our first principles thinking that India is a diverse tech market. When you raise a $250+ million fund, you can't start concentrating massively on 1 or 2 sectors. It's too risky. Please remember that our primary bets in every fund cycle are made within 3 years. So you don't get vintage diversification across 5-6 years. You get them over 3 years. So you can't like suddenly say, oh, I'll bet, and this some US funds have done. There's this legacy story of Kleiner Perkins betting on climate and that fund blowing up because they went all in on climate. So yes, climate's hot, but would I bet half the fund on climate? No. I would bet like 20%. If that was my budget, I would go to 25 because it's looking extra good. Maybe stretch 28, 30, but I won't go beyond that. So basically, we look at risk in four different sectoral buckets. One is software and related, like where AI, enterprise software, SaaS, dev tools, selling for the world. That's one bucket. The other is electric vehicles, climate, deep tech, includes life science and healthcare, second bucket. Third is fintech, because we believe if India has to become a $10 trillion economy, it will ride on the back of financial services as the first pit stop, because the money starts there. And the fourth is domestic consumption, and SMB enablement. And that could be commerce, that could be education, that could be health, it could be all of those elements inside of India, right? So these are the 4 buckets. And the way our partnership works is we basically, each partner focuses on one of these buckets and tries to win big. So eventually I would love to be able to say that the person who was managing software was amongst the best performers of this vintage. The one performing on EVs was one of the best performers of this vintage, etc. So nobody has slack. Everybody has to outperform. At least that's the starting premise. We'll see how it plays out. But we've gotten more and more rigid about this structure. And when you have a $200+ million structure, you better think about this.
On that note, it is time for us to head into a short break. But coming up next, we speak about funding venture